Hello and welcome back to The Note. One of the biggest developments last week was the attempt by Janet Yellen at the Fed to start to prepare markets for higher interest rates perhaps a little earlier than they had expected. Now that attempt didn't go down too well, and it raises the question of whether the world economy or financial markets are ready for higher interest rates, even if we've still got more than a year to wait. With me now to discuss this extremely difficult question is the head of G+ Economics here in London, Lena Komileva. Lena, thank you very much for joining me on The Note today. Let's start, you've broken this down into a series of categories. Let's start by looking at how unemployment has behaved in the major economies since the crisis. What does this tell us about the chances for higher rates?
Well, John, the whole debate about the forward guidance of the Fed, the Bank of England, the ECB in the past year has, as you say, narrowed the market's focus onto the likely timing of the end of the close to zero policy rate environment that we've had since the end of 2008. Yeah. But the debate about the real economy is still very much about how sustainable this recovery is. Right. And particularly how strong growth will be once that short-term sugar rush of zero-rate financial leverage wears off. Right. And so, while there's a good debate to be had about the fact that the global economy is much stronger systemically, cyclically than it looked 5 years ago, and that builds the case for removing some of that crisis-era sort of policy accommodation. The minute that market rates become more volatile, as we've seen this year, and central bank policy becomes less predictable, which is what's causing the volatility in the markets, means that we're going to get some systemic risk and cyclical volatility back into private sector balance sheets. So the question is, are private sector balance sheets ready? And there are 5 reasons. Right.
And this would be the first one, that labour force participation rate is still falling. There is no obvious sign of recovering in employment as you would expect at this point in the cycle.
You're absolutely right. The recovery hasn't kept up with population growth. And although unemployment rates have fallen in the US, in the UK, they started to nudge down parts of the Eurozone, we still have, even in the case of the US, which is one of the better performers, the employment population ratio is close to the lowest levels in 3 decades. So that raises a real question mark as to how sustainable the recovery is going to be.
Okay, and now the second point you wanted to make concerns inflation. Generally speaking, you think of high interest rates as something designed to counter inflation, and there doesn't seem to be very much.
You're absolutely right, John. Inflation has not kept up with GDP rates growth at all. In fact, we've seen a sharp decline in inflation trends across Canada, US, the Eurozone, the UK. The last couple of years, we are below 2%, the mark that's generally considered consistent with price stability across the board at the moment. And that also suggests that, well, it suggests 2 things. First, that central banks are not going to be facing an unfavorable growth-inflation trade-off anytime soon. And that also means that it's been hard to shrug off the excess capacity inherited from the crisis, as seen from the population growth ratios.
Okay, now on the subject of excess capacity, if we take a look at productivity, obviously one of the ways to gobble up that excess capacity is to be more productive, not necessarily something central banks can control, but that's not happening either, judging by these data.
Absolutely right. Central banks are assuming that stronger growth, stronger business investment and resilient business confidence will arrest the disinflationary dynamics happening across the major economies by bringing employment higher and real wages higher. But very much depends on what happens on the productivity front here. And productivity, like employment and inflation, has also not kept in line with the economic cycle. Another conundrum here. And it's very actually difficult to extrapolate strong inflation trends from the current strength of the business confidence from the PMI and ISM surveys, because there's ultimately a binary outlook here. Either productivity growth will not pick up, which means that real wages cannot rise sustainably, and it also means that the fiscal drag from higher structural budget deficit is going to be greater. That means probably the recovery will fizzle out in a couple of quarters or a year, which will possibly along the way expose a deflationary financial bubble in asset valuations.
Now, on that subject, let's look at the one final big important point, which is leverage. People are leveraging as though we were at the top of a cycle once more.
Absolutely. So according to the NICE debt data, institutional leverage as a share of the valuation of the stock market, the S&P 500, is now back at the levels, the highs of 2007 and 2008. So that means that the degree to which the market is invested in the lower for longer central bank rates narrative is really of the systemic proportions of the last major imbalance in financial markets, which triggered the Great Crisis. So that means central banks have got to be extremely careful here about this dichotomy that exists between over-investment, over-leveraging in financial markets versus a lack of productive investment, low productivity growth in the real economy. A premature rise in policy rates to fight the ghost of future inflation may well provoke another deflationary financial correction.
Okay, Lena, thank you very much indeed. That wasn't a very cheerful outlook, but it strikes me a very realistic and sensible one. We can all see why central banks might want to start raising rates. Everybody feels viscerally uncomfortable about such a low rate environment continuing for so long. But plainly, there are reasons to fear that we are still not ready to move off the sugar high.